Hi, I'm Mentor Hutt, Director of Business Development, and today I'm here with SVP Portfolio Manager Andrew Torres. Today we're here to discuss the recent performance and opportunity set in our alternative investment-grade credit mandates. November was another month that started quite different as it ended, as news around the new COVID variant emerged. Many asset classes were challenged by this uncertainty, as our alternative investment-grade credit mandates were able to provide their low volatility in this hazy environment. Andrew, can you touch on the main contributors to performance throughout the month?
Yeah, as you said, Hunter, the month started off on a fairly positive note, but we were getting concerned about liquidity especially heading into the U.S. holiday period. So we were actively reducing risk, and I think that actually protected us when credit spreads ultimately did widen quite sharply to finish the month. It was actually the largest widening we've seen in credit spreads since the pandemic started back in the first quarter of 2020. So we had our portfolio hedges contribute positively, and otherwise it was a challenging month, but one in which I think we navigated it reasonably well to escape relatively unscathed.
Thanks, Andrew. You mentioned you were reducing risk in November. Could you give us some more detail on the changes you made to the portfolio?
We actually reduced about 20% of our overall credit exposure. More specifically, we reduced our exposure to BBB low credits by about 50%. We reduced our energy exposure by about 40%. And the only place where we really added exposure was in our carry strategy. So that's where we took advantage of this steep 0 to 2 year yield curve, as we've talked about, to try to capture some extra carry for the portfolio, even as we were reducing risk. And
Andrew, how are you thinking about 2022?
Well, there's a lot of challenges here, as we've seen just with the volatility of the recent weeks. But this all comes back to the fact that we are emerging from the pandemic phase. And as such, central banks are looking for ways to reduce the amount of liquidity that they're currently pumping into the system. And when you have this combination of high inflation and ultra low interest rates and central banks in withdrawal of stimulus mode, it makes for a pretty tricky cocktail. So it's going to be a difficult environment. I don't think just for fixed income, I think across many different asset classes. And really it's about being nimble. And as we showed in November with some of the significant risk changes we made to the portfolio, this is a portfolio that can be nimble. Our portfolio managers are prepared to act when they think it's necessary. And given that spreads are backing up to finish the year here, I think it's actually setting us up for potential for quite an attractive 2022 in terms of potential for risk for credit performance, even as some of these central bank measures might be affecting interest rates.
Thanks again, Andrew. On behalf of the CI Global Asset Management team, we want to say thank you for your continued support, and we very much look forward to connecting in 2022. If you have any questions, please feel free to reach out to a member of our team. Thank you, and happy holidays.